Good morning and welcome to the Downing Strategic Microcap Investment Trust PLC Investor Update presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Nick Hawthorne, Fund Manager, and Judith Mackenzie, Partner and Head of Downing Fund Managers. Good morning.
Good morning, Paul.
Good morning.
Thank you. Right, we're going to run you through the update for the Downing Strategic Microcap Investment Trust. Just a little bit about Downing to start with. So we have about 1.7 billion under management. We've been around for over 30 years. We've about a third of that in publicly listed assets, and I started Downing Fund Managers in about 2010. And Downing as a whole has got about 180 members of staff, and we really specialise in public equity, energy and infrastructure, and property development. So the team that you have in front of you today, my background, I'm partner and head of Downing Fund Managers, and I was previously at Acuity and Aberdeen Asset Management, and I've got over 20 years, in fact over 25 years, small cap experience and micro cap experience, both in the public and private markets. Nick, do you want to talk about yourself?
Hi, I'm Nick Hawthorne. Before Downing, I was at BP Investment Management, and before that, I was at Aberdeen, and then I joined Downing in September 2015 to help Judith and the team on the smaller company mandates here. And this slide explains the opportunity set that we're investing in with DSM. So, as most of you will know, we're investing in sub 150 million market cap companies, and we like that end of the market because it's the most inefficient. So there's less sell side analysts and there's less buy side analysts looking at the companies in that space. Because of that and because of the inefficiency, you get companies at better valuations, but you also have the highest count of companies as well. So the opportunity set is much larger than other parts of the market. When things go well, what we attempt to do is walk companies up that valuation curve. So hopefully we can invest on companies and on 10 times earnings and walk them up the curve as they get larger and more institutional funds can come into them, and you get that multiple expansion along that journey up to kind of 15 and 20 times.
So, sorry, flicking the wrong way there. So what the investment trust does is we're investing in 12 to 18 companies under 150 million market caps, and we're really looking to take advantage of that market inefficiency that Nick's just talked about. And what we're doing is we're seeking out catalysts. So we're taking these strategic stakes, anything between 3 and 25% of the underlying equity of the company, and we're working with management teams to try and improve their valuations and close that gap between what we believe the intrinsic value is and the market value. So you do get a lot of pricing anomalies in this area of the market, and really we're taking the opportunity of that, using these catalysts and driving value in the portfolio. So year-to-date summary, it's been a pretty torrid year, as most people know, for smaller companies. What we found is that we're now in year 5 of the journey of the investment trust, and we spent the first year doing making a lot of the investments, and we spent years 2 and 3 really doing quite a lot of the heavy lifting, and management teams doing the heavy lifting in terms of improving their outlook for earnings. And then, of course, good old COVID hit, and what we're finding now is that these companies have come through the other end of COVID. They're getting back to pre-COVID earnings, but they're doing it on much improved operational structures and balance sheets, and really starting to drive those catalysts that we talked about earlier. So the NAV per share is actually down about 6%, but that's compared to a market that's down about nearly 30%. The discount to NAV is about 21%, and that's reflecting extreme pessimism over the prospects of UK small and micro-cap companies. But hopefully, as we go through the portfolio, you'll see that we think that pessimism is unfounded. We've been pretty busy in the year, so we deployed about 4.5 million into 2 new investments, and that's National World and The Works, which you might recognise from the high street. And we've also topped up 4 existing holdings. We also raised about 3.5 million from trimming existing positions and reinvesting into other parts of the portfolio. And we talk about catalysts a lot, but some of those examples maybe show through in the active engagement that we've had with our companies. National World, for example, we interviewed all the non-execs and chairs and exec team before we made the investment. Synectics, we've got their interims out today, so ongoing board engagement there. We based the incentive scheme and have really been hopefully assisting them in driving through that gross margin improvement that they talk to in the market quite a lot now. Digital Box, we have our observer rights there, and the board structure has been improved and ongoing strategy discussions. And Fire Angel been on site a fair bit and looked at the strategic and financing and incentive options there with the board. So quite an active year.
And this slide's just to show where we made gains and lost gains over the year to date. So if we start top left on the positives, HSP has been a standout performer for us over the 6 months. If we think back to 12 months ago, actually, earnings expectation for this year was about 40 pence per share, and it's now over 90 pence per share. So more than doubled their earnings expectation there. All of the divisions are performing well, but the main one is the German associate. It was a solid balance sheet, as we've got there, 14 million of net cash, but there's also a loan out to that German associate I just mentioned, which we expect will come back at the full year. So we'd expect to see that cash balance significantly higher than that. And again, on a PE of 6, so particularly undemanding in terms of valuation. Digital Box, Judith just touched on it. Again, another one which has beaten earnings expectations in the year. I think they beat guidance 5 times coming into the end of their financial year. A lot of that has come out of the 2 core assets, Entertainment Daily and the Tab. And again, this is a company which is fairly inexpensive with a solid balance sheet, 1.8 million of net cash on an 11 million market cap company today. I would expect that cash balance could potentially double into the full year this year. But again, an EV/EBITDA of 8 times and a nice clean business. Most of that EBITDA falls down to the bottom line and to cash as well. And if I take Volex on the negatives, again, people that have followed DSM for a while will know Volex and our views on the business fairly well. I guess the main thing here is that the shares have about halved, but that's not been, in our view anyway, it's not been based on fundamentals. Yes, there's been a bit of margin weakness and debt is higher on the back of investments, both working capital and capex. But we don't think that there's any kind of fundamental issues here that have led to the multiple coming off by about 50%. And again, the kind of long-term catalysts there in EV, in data centers, and in healthcare, we think are a nice place to be over the medium term.
I think, looking at the slide, you look at the PEs of these companies and the EVs, EBITDAs, and I think our average at the moment is about 8-9 times. And some of these companies are on PEs of 5 and 6, which seems crazy, with good earnings and strong balance sheets. So that's, again, some of the work that we have to try and do to get these companies realised a bit more. And recognise a little bit more. Ramsden's we talked about, I think, in the past before quite a bit. We're really seeing them returning to pre-COVID type earnings, and we think there's quite a lot more to come in half 2 because they're going to benefit from FX sales. Also, their jewellery side is doing quite well. It's got about 9 to 10 million worth of cash in the balance sheet and on a PE of about 11. So that's a company that's done quite well for us over the last 12 months. It's rather ironic to see that Centaur and Adept haven't done that well in terms of share price performance, because actually they've hit their own targets, internal and market forecasts as well. And Centaur, I think, has probably had suffered a little bit because it's had quite a lot of retail stock in it, or retail investors, and maybe some retail have come out of that position. We believe that their plan to get 23% margins within the next year is well in line, And that really puts it on a double-digit free cash flow yield and an EV/EBITDA of about 6 times if you're looking forward. And Adept just came out with its full year results today, buy in line, and really showing that the market's come back post-COVID. Although there are still some headwinds on the supply chain issues, their recurring revenue has increased. So we're very happy with those numbers. And again, a double-digit free cash flow yield and a PE now of about 5 times. Performance update, those are numbers that you can look at yourself, I'm sure, and quite small. So we've got some charts on where we think things are in the market. So bear with us on where we think sentiment is.
Yeah, so the next 2 slides are a couple of charts that we thought we could talk about. So the first one is consumer sentiment, and this is S&P, but for the most part, we think that that will be similar to the sentiment in the UK. If not, the UK is going to be slightly worse than this. But the idea of the chart is to say, yes, consumer sentiment is weak, and actually we think there's most likely more headwinds on the consumer sentiment side, especially as we go into the third quarter of this year, and potentially cost of living gets much tighter again. But coming out of these, you can do exceptionally well. So the deepest points on this chart, on the other side of that, you tend to you get 20, 24, 25% outperformance on the other side. So that's the opportunity, and that's what we're kind of thinking about going forwards. And again, if that was the demand side, this is now supply side. So we all know about inflation, cost inflation, but we are now seeing some commodities starting to ease. So we've got copper, oil, and corn on here. All off their peaks, albeit nowhere near back to the kind of levels that they were before COVID. And again, the other note just at the bottom there is obviously shipping costs have come down a lot. So now just about $6,500 for a container, where it had been, companies that we were speaking to 6 to 12 months ago were having, talking about container costs of kind of $20,000 to $25,000. So a long way off peaks, but still quite a way above where we were before COVID. So
we, as you can imagine, with this kind of macro outlook, we do spend quite a lot of time thinking about how the macro is affecting the portfolio. We're bottom-up fundamental investors, value investors. However, it would be a bit naive to think that our companies wouldn't be affected by the macro. So what we've done on this slide is just look at those headwinds and create a little bit of a heat map to show where we're concentrating and where we believe that actually the companies have got good opportunities, and also where there might be some modest headwinds. I would stress, though, in all of these companies, we believe, and we've already seen, that they've got pricing power, and that is so important in this type of market, even in the type like of Real Good Food, where it's consumer exposed and maybe slightly commodity orientated. We're seeing that they are able to pass through price increases, and that's really very important. And that's because these companies tend to be quite niche, and therefore, there's good barriers to entry, and people want the products fundamentally and services. So we look at revenue risk, we look at margin risk, we look at cash flow and financing and overall balance sheet strength. Nick, I don't know if you want to pull any of your ones out there.
Yeah, I think, if we look at Flowtech, it's mostly positive. Things we're not too concerned about. I guess what would flag up is they do have a net debt position. But what we do like about this business model is that in times of weakness, and this is actually something we saw in COVID, in times of weakness, they can unwind their stock levels and turn their stock into cash without investing into new stock. So actually what we saw in COVID was a business that made an accounting loss, but actually a cash inflow of £9 or £10 million off the top of my head. Again, Digital Box we touched on. It is kind of ad sales exposed, which is not an ideal place to be in a market where consumer confidence is low and potentially gets lower. But we think that they're well, they are in the mobile and digital space, and that is and should be more defensive. But again, the other parts of that model, or the other parts of the heat map here, are obviously positive. Again, if we touch on Volex, because it's obviously has been one of the largest positions, negatives, of course, are going to be cash flow over the next, well, certainly this year and potentially next year, as they invest for the business to become larger. And again, in this kind of market, that hasn't been taken all that positively, but we think that's the types of decisions that the management team should be making, and the opportunity to buy cheap assets in this kind of market should play out over the medium and the longer term. But again, as I said, your net debt, 74 million net debt position, but that's a new facility and it's fully committed, so we're not too concerned there either.
I think it's worth pointing out that some of these companies, and we talked about the J curve and the work and the catalyst that management had been putting in place, pre-COVID and during the COVID years, but it has meant that they've got their own levers to pull. They're not market dependent as such. And the likes of Fire Angel and Synectics, you're seeing gross margin improvement, which, given the headwinds in supply chain and all the other issues that we know about, is actually pretty commendable. And they also don't have balance sheet risk either. So we're finding that we've got some niche businesses that are regulatory driven, that are now very much in that recovery mode post-COVID, and despite these headwinds are capable of improving or at least keeping earnings where they are. I think there'll be a lot of companies out there. We're already seeing it in terms of profit warnings more widely in the market. I think it will be a difficult third and fourth quarter this year. So therefore, we're looking at as being as defensive as we can, and got companies like Ramsden's, as you see there, they've got good tailwinds there in the operating leverage. They've got positive cash flow. They've got net cash in the balance sheet. So those are the kind of assets that we really like holding through this kind of market, with their own levers and catalyst to pull.
And yeah, so this is just, again, kind of sum up our views on the market. There's no kind of particularly special insight here. We do think that the market's going to be particularly volatile, and there's going to be a lot of nervousness. Multiples have come off a lot, especially in the most expensive businesses. If we'd look back 9 months ago, multiples have halved or more than halved. But we do still think that pockets of AIM still exceptionally expensive. And actually, I think we could see multiples there, halving again potentially. So how do we position for that? As Judith said, the EV to EBITDA of the portfolio is 8 times. The PE of the portfolio is 10.5 times. And we've got good companies, mostly with net cash balance sheets. So that feels like a fairly defensive place to be, both in terms of balance sheet and in terms of valuation. I think, as again, as Judith said, companies that are weak, that are going to fall over, are the ones that are poorly financed, and the ones that find that they can't pass on costs to their customers. And we have seen, even just particularly in the last week, actually, some of the more kind of commoditized companies coming out with big warnings, big cuts to guidance of kind of 30 to 50%. So, we're fairly comfortable with where our companies are in that sense, and that's what we've been spending a lot of time with management teams.
And also, it's worth pointing out that in volatile markets, there's some really good opportunities. And what we found maybe over the course of the last couple of years that are momentum-led, we were seeing good growth companies, but they were priced wrong. So actually now you're finding that those good quality growth companies are a much more sensible valuation. So actually, it's really quite an interesting time for us. We don't like to say that we're optimistic too much when everybody else is looking quite depressed, but actually this is the time for this kind of trust to be able to outperform, as we've already seen.
Oh, I think we skipped a slide. Jump back. This slide we've kind of mostly covered, but again, what we're looking for, what we're comfortable with, is the ability to pass on costs. Most of our companies have net cash balance sheets, and again, the multiples of the companies as a whole are low. I think the other thing we've been looking at is actually companies that are still below their level of earnings before COVID or sales before COVID. So we're still kind of viewing a good handful of those companies as exiting COVID, and that should be a good catalyst for earnings as we go forward. And I guess the last thing, just on portfolio, is we have over 10% cash, and this is obviously a fixed capital fund, so we're not going to be subject to outflows in the same way as other open-ended small cap funds, and that is a big advantage dealing with illiquid companies. So again, there's a good opportunity set of cheap companies. They're becoming cheaper, and potentially if there's more headwinds, which we expect, then that should lead to more opportunity.
So why now? Well, the catalysts are in place to generate value over the next 12 months. We're already beginning to see it kick through, and you're seeing that these companies are resilient even in these really challenging markets. So the catalysts across the legacy holdings are most certainly very much in place and playing through, and therefore we're not expecting to be bunged about by the market as much, because we feel that they've got their own levers to pull, and it's a bit of a recovery trade. And the market is probably helping us a little bit. That value rotation, the move into value from growth, has strengthened, and that's driven by interest rate hikes, which is obviously going to continue, I suspect. And we're sitting at a crazy double discount. So they're sitting at a discount to the intrinsic value, what we believe the intrinsic value of the portfolio, but we're also sitting at a 20-odd% discount to net asset value. So that really does de-risk the entry point for people coming in at this time. It's worth pointing out that our pre-COVID discount averaged about 5%. So it really has been the effect of COVID that has pushed that out wider. And we believe that the underlying company outlooks are pretty strong given the background, and the companies themselves are very well capitalised. And I think that's the formal part of the presentation over, and we will take any questions, which we do.
Fantastic, Judith, Nick. Thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Just while the team, as Judith say, take a few moments to read those questions submitted already, I'd like to just remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Judith, Nick, as you say, you have had a number of questions come through. If you could just click on that Q&A tab and just where appropriate, just read out the question and give your response, perhaps starting at the top. Thank you.
So Nick's just moved it from the top.
Yeah.
Got it now. What's the impact of the recently announced sale of Downing VCTs on the trust? Are you losing valuable connections and insights as a result of this? Good question. So Downing have recently sold the Downing 1 and Downing 4 mandates to Foresight. And that has meant that our ventures team has moved across with to Foresight. As I look, actually, I can see them just across the water from us, so they're still very physically quite close to us, and clearly we've worked with them for many years. What does it mean for the trust? So the VCTs are shareholders in the investment trust. The board are independent, and they have got discretion over the portfolios. So in other words, it's the board that say yes or no and veto any investment decisions. So it's the board that obviously had a strong relationship with Nick and myself and the team here, and I have managed the AIM portfolios within those VCTs for probably about 12 years. So very close ties to that board, and we will continue, Nick and I will continue to manage the AIM portfolio side of the VCTs until such a time that that board would like to make a change. And that we envisage that that's going to be for quite a long period of time. Until things have settled down at Foresight, because they don't have an AIM team. So the relationship is strong, and the relationship has not changed in the way that the board always make the decision on what they're going to either buy, sell, or whatever in the portfolio, and that is true of Downing Strategic as well. If you look, you can see that Downing 1 board decided to buy some more stock in DSM, actually just before that deal was announced. So you could probably infer that the board knew that they were moving to Foresight, and they were still very supportive, and they bought stock in DSM because they thought it was cheap. In terms of not having the ventures team, we still have the healthcare ventures team within the business, the Downing business, and we still have a very strong relationship in terms of deal flow passover with the team that went to Foresight. So the way it worked before was that sometimes the ventures team would see something that was in the AIM space and pass it over to us, but very often we were also seeing things that were maybe pre-IPO or maybe a few stages before IPO that we were also passing over to them. So we've always shared deal flow, just like we would do as well with other VCT houses. So that relationship should continue, and they're also our friends as well, which also helps. So hopefully that answers the question.
And we have another question on the level of DD that we undertake, and how does that impact the investment universe and timing. The amount of DD can differ on a company by company basis. So if I take an example, Volex, which entered DSM in 2018, we actually started work on that about 18 months before we invested, and that I would say that that's fairly kind of atypical. I would guess that the timing, the DD length is maybe more like 6 months or thereabouts. It kind of depends. As Judith said, what we find companies that we like and quality and management teams that we like, but they might not be a valuation that we like, and those ones we can do the work and then we'll park them, and we meet the management team twice a year, and if the valuation comes back, then it falls onto our hit list for DSM. So in that way the DD timing can be much longer. In other cases, we will have deals that come over our desk, and they might be in existing DSM holdings, or they might be in existing Downing holdings within other mandates. Or they might be completely new. So obviously, new deals are quite difficult. If you've never seen them before, we're unlikely to be able to get comfortable with them for DSM. For this mandate, we want to be interviewing the chairman and the board members at a minimum, and then also attempting to do some customer and supplier DD as well, and that is difficult to do in a week. So those ones tend to fall away. So the main ones we tend to focus on are companies that we know, and again, it might be companies that we own just now within DSM, or it might be companies that we own elsewhere within other Downing mandates. And another one on why are we still holding Volex given the scale of its market cap. So the mandate specifies sub 150 million market caps at the time of investment. So we can hold companies that become much larger than that. And indeed, Volex was well below the 150 million market cap at the time we invested. So it ticked that box. We think that if we were to be selling all of our holdings at 150 million market caps, given where we'd expect they can get to in a normal market, then you would be forgoing quite a lot of opportunity and quite a lot of upside. And we don't feel that we want to do that, particularly when you've invested the time and effort to get to know the business and understand the opportunity. So I think I said at the beginning, the idea for us is to buy companies on, as an example, 10 times and or small companies on 10 times and walk them up the market cap curve to 20 times. And if they can expand their earnings on that journey as well, then we do especially well. But there is an inflection point about 250 million market cap that you do see much more institutional demand for these companies. And again, Volex is a good example of that. When it started to get to that size that other AIM investors could look at it, and the multiples started to expand quite quickly. So short answer, we think we'd be giving away too much opportunity to divest those opportunities that quickly. But it's also worth pointing out, Volex, we invested on a cost basis. I think we invested about £5 million. We've taken over £10 million out of that investment on that journey, and we obviously still have the balance in today at about 6.5% of NAV. So it's not like we sit on the investment and we don't take any cash out.
I think it's also worth pointing out that if a lot of what we get in companies under 150 million market cap is great access to management. If you pitch up the door of GSK, you're not likely to get the kind of engagement that we do when we pitch up to one of our companies at maybe 40 or 50 million market cap, where they do feel a little bit unloved. So we would sell out of a company when it hit our intrinsic value, or where something changed in the investment case, but also where, say, if the market cap ended up going like it has done, up to 400 or 500 million market cap, then, and we didn't have the access to management, then we would take a different view, because that's one of our USPs. And I know that Nick has a very strong relationship with that management team, where you're probably speaking to them every 2 or 3 weeks, really.
Yeah. I mean, that's obviously key. So we started off in Volex as a 7.5% shareholder, and we still have the engagement of a 7.5% shareholder, albeit we own significantly less than that. I think we're 2.8% or thereabouts now. So if the engagement falls off, then obviously that's a time for us to sell, because we don't have the access to management.
That's a good question. Can you comment on Richard Staveley's being on the board of Centaur Media? Of course, it bodes well for the investment case, but could you maybe inform us on what he might be trying to achieve through being on the board? Good question. So Richard Staveley is a fund manager in Rockwood Investment Trust, which is another small cap investment trust. The overall manager is Harwood Capital. And I believe that Harwood have a policy that when they get up above 25% of the underlying equity in a business, that they will always put somebody on the board. And this is a position that is in Richard's trust. So it's no surprise that Richard has moved onto the board there. What is he trying to do? Well, hopefully he's trying to make sure there's good governance and an effective board, first of all. I don't know what the modus operandi is, but I could maybe guess that he is looking at this business in the same way as we do. And that is that the sum of the parts is greater than the current value. So you've got two quite different businesses within Centaur Media. You've got The Lawyer, which is a long-standing publication for, unsurprisingly, the legal market. And then you've got a marketing services and intelligence business that, again, nicely profitable. These businesses together have got a free cash flow yield of about 14-15%. And if you looked at them separately, there's about 2.5-3 million of central cost there. If you looked at them separately, you can certainly see that some of the parts would be more than where the business is maybe sitting at the moment. There's no real synergies between the two businesses. So I certainly think at some point there will be some corporate activity there that will realise value and generate that sum of the parts valuation. That's my thesis, not Richard's.
We've got a couple of questions on the discount and how we're going to tighten that, and also another one. We've got you got 21% discount and 10% cash. Have you considered buybacks? We do. Maybe Judith can answer better detail, but the board buyback shares.
We have got our exceptionally proactive and engaged board, and in particular our chairman, who is very well versed in discount control mechanisms, and who I would say has probably pretty much a daily dialogue with our house broker. So he is there to protect value, and you'll have seen a good level of buybacks over the last 12 months or so. But our job is to, number one, outperform the market and perform, and get new institutions involved and really narrow that discount. We feel as though we're on the front foot now with the more recent performance and the catalysts that are triggering through in the portfolio. You maybe have seen that we have recently changed the broker. So FinCap are now the broker and are suitably energised as we are to go out and shout about this portfolio. So we don't want to be relying on the chairman to pick up stock in the market, but it's certainly a mechanism that we do use. and is guided by the chairman.
There's quite a few questions asking about investment theses of holdings and new holdings, and I guess I would just point to the investor letters as a good source of information for those, particularly the last one that we published a couple of months ago has all the a kind of page each on the theses for the new investment. So I kind of point there as a first port of call, and if you've got any other questions, then obviously we can pick up.
And when is the next investor letter coming out, Nick?
Good question. End of summer.
Whenever summer is. Right. I think we'll probably just take one last question if I can. Are you expecting to need to support any portfolio holdings with fresh equity this year? What factors do you use to consider when to support a portfolio company, e.g. Fire Angel, versus not supporting, e.g. Red Hall? Another good question. No, I don't think we should. The only time I think we might have an opportunity or otherwise to support existing companies would be for M&A activity. And we can't give you a forecast on that, but that's really where we would see any sort of follow on. I think we will follow on into existing positions on bad days in the market. You can pick up stocks that we know very, very well on bad days at crazy prices. So we will continue to do that. But I don't envisage that we need any shoring up of balance sheets. They're pretty well shored up at the moment. On Fire Angel, that was, the decision there to follow on was quite clear because we had good knowledge of what was happening in terms of the pipeline, and most importantly, the gross margin improvement plan. So that gross margin improvement plan started with management probably about 2 and a bit years ago, and they helped us understand the mapping through of that GM plan. And so therefore you could see where things were going from a regulatory perspective on the top line, and we also had a really good understanding of where things were going on the gross margin plan. On Red Hall, I think there was definitely a desire to try and support that business. We didn't have confidence from the chair and the management team to be able to put a plan in place in time, and HMRC sadly, just at the same time as they came into British Steel, came in and pulled the rug away. So I think, you look at where Red Hall and the Booths business is now within Avingtrans, and clearly you can see it was not a bad business because it's now pretty successful. It was a small contracting business that didn't have enough of a strong enough balance sheet and confidence of management team to be able to embark on a refinancing. So quite different scenarios to the one that we had at Fire Angel. We had a very good runway into assessing the refinancing opportunity, but certainly no prospect of anything like that in the portfolio at the moment. And as we said before, balance sheets are pretty strong. So Paul, I think that's probably us for just now.
Fantastic. And of course, you can, if there are any further questions that come through, you can review those, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Judith, perhaps just before redirecting the investors to provide their feedback, which I know is particularly important to yourself and Nick, if you just had a few closing comments, please.
Yes, despite these horrible markets, we're really bullish about the portfolio. We really feel it's come of age. It's gone through the hard yards. We've gone through that J curve. You're already seeing the results coming through, despite really strong headwinds, especially in supply chain over the last sort of 6-8 months or so. You're seeing that these companies are resilient, and also the volatility in the market, as we said, is a great hunting ground for our type of mandate. We can take our time, invest in companies that we've known for a while, and get the chance to do our due diligence, but more importantly, get an entry price that is really now quite attractive.
That's fantastic. Judith, Nick, thanks again for updating investors today. Can I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a moment to complete. I'm sure it will be greatly valued by the company. On behalf of the management team of Downing Strategic Microcap Investment Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.
Thank you.
Thank you.